Welcome, everybody. Thank you so much for joining us for this presentation. We're going to get going in about 2 minutes. I just want to give everybody an opportunity to get logged on. Um, Please sit back, relax. We'll get going in a little less than 2 minutes. Hello, everybody. Again, thank you so much for joining us for this presentation of 6 barriers to investment success, uncovering your behavioral biases. We are going to get going in less than 1 minute. Please sit back and enjoy a little bit of this music, and we're going to get going very soon. All right, everyone. Thank you once again for joining us for this presentation of 6 barriers to investment success, uncovering your behavioral biases. This evening, we're going to delve into the mind a little bit and see if we can figure out why it is that we do some of the things that we do without even knowing that we're doing them. So with that, let's just move right into this. As with all financial presentations, we have these very important disclosures. As you take a peek at these, I just want to remind everybody that I've muted everyone because we're also recording this for future use on my website. If you have any questions whatsoever or comments, please type them into the chat box. I will try to answer them live. But if I can't get to them, I do promise I will get back to you individually and answer any questions that you may have. So having said that, let's get started. So every day we're faced with decisions. Some are easier than others. For a moment, I want you to imagine that you open your refrigerator door and you want to grab a snack, but you see a salad and you see a piece of chocolate cake. For many of us, this is a challenging decision. Of course, most of you who know me know which choice that I would pick right here. We know that the salad is healthy, but that chocolate cake sure looks good. It's like there's two conflicting voices inside of our head. Well, in fact, that's not too far from the truth. You see, to make decisions like this, the frontal cortex of our brains processes lots of information to make logical and informed decisions. You can imagine this part of your brain saying things like, the salad is healthy, you'll feel good after you eat it, plus you've been meaning to up your daily intake of leafy green vegetables anyway. But then there's this little part of the brain known as the amygdala. It's often referred to as the reflective brain because it connects stimuli in the world all around us to experiences. And in this case, it connects the stimulus of the taste of your past experiences with the cake and the salad. And it may tell you that the cake is a much more enjoyable choice. So while our frontal cortex tells us that the salad is a healthier choice, our reflective brain may tell us we should go ahead and go for the cake. Now, for the caveman, the amygdala may have helped when confronted by a saber-toothed tiger. Based on his past experiences, the amygdala would have told the caveman, now might be a good time to run. In fact, The amygdala is often associated with the fight or flight response. But letting our reflective brain control our reactions when making financial decisions may lead to some undesirable outcomes. And that's what we're going to go over tonight. So as humans, we just need to be aware of our reflective behavior and how it impacts our investment decision-making ability. Today, we are going to make sense of some of the common barriers to investment success and then cover the behavioral biases that might reflect and affect our financial decisions. Those biases we are going to cover this evening are availability bias, herding, loss aversion, present bias, anchoring, and home country bias. So let's get started. The first concept I'd like to discuss is called availability bias. And it says that our thinking is strongly influenced by relevant, recent, or traumatic events. Now, here's a question for you. What would seem more dangerous to you? Taking a selfie with friends or going diving with sharks in the ocean? Well, surprisingly, for the last 5 years, more people have died attempting to take selfies than they have from shark attacks. Now, while it's likely true that there's certainly more people taking selfies in these last few years, the number of people swimming with then sorry about that. I saw a flash outside the house and I distracted me for a moment. As I was saying, so even though there's more people taking selfies than swimming with sharks, the chances are that the shark attack made more headlines than those people who have met their demise through selfie mishaps. And that's because the trauma associated with shark attacks is terrifying. Now, let's look at what, in our view today, would be a terrifying view. And let's flash back to the downturn in the market in 2008. And it was pretty bad. The S&P 500 was down 37%. This dramatic market event had a strong impact on how investors behaved in the years following that downturn. But who remembers the following year in 2009? That may be a little harder to recall because it wasn't as much in the news as it should have been. But the S&P 500 index actually bounced back to 26.5% in 2009. But when a survey was conducted just at the end of 2009, and it asked people how they thought that the stock market had performed in the past year, they had this surprising response. While the market was up in 2009, 2/3 of the respondents in this survey thought that the market was either down or flat. The dramatic market events of the previous year in 2008 left a lasting impression on investors. The danger of basing investment decisions on market perception rather than fact is that investors may pull their money out of the market at the wrong time and miss some of the best days in the market. This may help explain why the average annual return for the S&P index for the last 30 years was up almost 9.96%. But the average annual return for the average investor was a little over 5%. That's nearly 5% points difference between what the stock market did, and the investor would have missed out on that difference. So the next concept is always a fun one because I think we see this pretty much in everyday lives, not just in financial, but it's called herding. And with herding, we generally feel most comfortable following the crowd and tend to assume that the consensus view is the correct one. That's because we fear making mistakes or missing opportunities. Now, in a perfect world, I would be able to click on this button right here and we would be watching a candid camera video from back in the early 70s, late 60s. And pretty much what it shows is this gentleman, he gets into this elevator and he's the subject, and three of the Candid Camera crew get in with him. And the Candid Camera crew actually face the back of the elevator while this gentleman is facing forward. Well, within a very, very short amount of time, the gentleman who's actually facing the proper way is pressured by himself to actually turn himself around and face the back of the elevator like everybody else in the elevator is doing right now. And they went on and they did this 2 or 3 different times, and it was very consistent that the subject each time, without being told or prodded, would do exactly what those people in that elevator would do, just because they were there. It made no, he was the only sane one who was facing the right direction, but he would actually turn so he could be doing the same thing that those staged people were doing. So just like it's hard for that elevator passenger to go against what the other people in that elevator were doing, investors often act in a similar manner. To see this in action, we take a look at some of the examples of financial bubbles that have occurred throughout history. During the run-up of these bubbles, investors may have feared missing out on what at the time looked like an amazing opportunity. They actually followed the crowd as they bid up prices to tulip bulbs, stocks, real estate, all to unsustainable levels, often within a very short time frame. But even more quickly than they expanded, these markets burst and contracted, dropping as much as 82%. There's a strong temptation for investors to jump on bandwagons based on emotions rather than sound financial strategy. And to that, I might also add to brother-in-laws and well-meaning people who all seem to know a lot, but they fail to look at the way these biases impact us. Now, how does going with the flow affect us? Okay, so the green line represents performance of the S&P index, and the blue shading represents the flow of money in and out of funds. As you can see, when the S&P index performed well during the internet boom through 1996 and 2000, there was an influx of money into equity funds. So in other words, what they were doing is they were buying at the highest possible point that they possibly could have. Conversely, when the markets pulled back after the housing crash of 2004 through 2010, investors withdrew their money from the equities markets. So again, here we actually see that they were selling at the very worst time that they could have. So it doesn't take a financial genius to know that if you buy high and sell low, that is just a recipe for disaster. And we're going to get into this a little bit deeper, but the importance of staying invested all the time over the long periods of time is always better than trying to time the market. So the next bias we are going to discuss is loss aversion. And it can be defined as our preferences to avoid losses because the associated pain is much more intense than the reward that is felt from a gain. In fact, studies have shown that the pain of a loss is almost twice as strong as the reward felt from a gain. Unfortunately, many of us have learned the pain of loss at a relatively young age. Now, again, in a perfect world, I'd just be able to click a button here, and what it would do is it would take us over to Jimmy Kimmel. Every year he would do this bit where he would have the parents of children tell them that on Halloween, the next day, that the parents ate all the candy that the children just got during Halloween. And you can imagine how some of these children might have acted, or you might just say they acted like children, like you'd expect them to, and they would just really go ballistic. The point being here is clearly the parents didn't do what they said they did, but the perception that the child had was it was every bit as real, and that's how they responded. So what we're going to do now is, as emotional investors, we tend to make decisions to avoid the pain of loss. For example, when the dot-com bubble burst, investors panicked and pulled their money out of the market. And this contributed to an increase of 491 billion with a B moving into cash during this period. Similar movement occurred during the global financial crisis just a few years later, with investors piling 943 billion with a B into cash. To avoid more losses after the market crash, investors may have been tempted to move their investments to a place that they perceived as a safer investment. But what those investors did not realize is that this security comes at a cost. If you look at the average money market account yield since 2000, you see that while the yields bounced between 1% and 4% through the first quarter of 2008, it's been close to zero for the past decade. Investors may be surprised to learn that once inflation is factored in, staying in investments that they consider more secure while they wait out the stock market volatility may actually lead to erosion of their purchasing power. Over the past 19 years, average money market yields on an inflation-adjusted basis were only positive about 15% of the time, and the positive yields in 2009 and 2015 were largely due to periods of deflation. So we're going to go back to that same theme where staying invested all the time is much better than trying to time the market. And as you can see from this, when you jumped into what you perceived as a safer investment, actually wound up costing money when you figured in what the inflation actually brought the real cost down to. So the next bias we're going to talk about is called present bias. It's also known as immediate gratification bias. It occurs when we overvalue the immediate rewards at the expense of long-term goals. I've been having this conversation with my daughter and somebody that she's working with, where they love the current and they can't see the future at all. But I digress. One of the best examples of this was something known as the marshmallow test. And yes, that's what it was called, the marshmallow test. My presentation last month, I actually touched on this as well. It's been repeated numerous times, but it was originally conducted back in the 60s and early 70s at Stanford University. In this test, a single marshmallow was placed in front of a young child with the instruction that they could eat that one marshmallow now, or if they waited a period of time, about 15 minutes, they'd receive a second marshmallow. Some of the kids got pretty creative in finding ways to distract themselves from eating that one marshmallow right away. However, only a third of the children were able to delay gratification long enough to receive that second marshmallow. Now, you may not be as enticed by marshmallows, but what if I gave you the choice between a brand new car today or a comfortable retirement in the future? Point here, whether you're a kid or an adult, delaying gratification may be challenging, but ultimately it is the only way to lead to financial success. The tendency to focus on the now, it also can be seen in our national savings rate. For the last 60 years, the percentage of disposable income people have been saving has generally trended downward. We've seen a few spikes during market recessions, but as of December of 2019, the national savings rate was only 7.5%. The lack of planning and saving is having a significant impact on those nearing retirements. In this slide, when we look at the retirement assets of people from 55 to 64, we see that although 18% of those surveyed have more than $500,000 in their retirement portfolios, a shocking 25% haven't saved anything at all. Point here is delaying the gratification is very, very important. And I know it's hard to do, but it is such a muscle that we want to build because it's going to lead to success. Our next investment behavior that we're going to be discussing is anchoring. Now, this is the tendency we have to focus too heavily on one piece of information when making decisions. A perfect example of this anchoring occurs when we search for airline tickets. For example, let's say you go online to a travel website and you see a quote for $400 for a nonstop flight, but you don't purchase it at the time because you're planning on coming back and doing it a little bit later. But when you come back to that same website, you see that the price of that same flight has increased to $500. Now, how many of us would be kicking ourselves for not buying that ticket at the original $400? So then what if I told you that when you originally searched for that same flight, the travel website quoted $600. And then when you came back to that same website later, the price had dropped to $500. Now, how would you feel about making that purchase? Feel pretty good. In both scenarios, you purchased the price of $500, but your feelings about your decision would vastly different based on what price you used as your anchor. Now, anchors have a powerful hand in our decision making and can create unrealistic expectations for us. There was another survey where investors were asked to tell their average annual portfolio return expectation over a 5-year period. And the median response was 10%, which I think is a little bit high, but if that's what the survey showed, that's what it showed. But then they hypothetically presented a market upturn that returned 20% for a particular year. What do you think happened? Investors' return expectations then shifted to a median response of 20%. The introduction of that hypothetical 20% anchor caused investors to abandon their original expectation of 10% and expect even stronger returns that match that same market. Later, when those same investors were presented with a hypothetical market that was down 20%, the median return expectation was a positive 3%. Surprisingly, investors expected to outperform a down market by 23%. Now, let's see how anchoring can influence the way we feel about our investment plan. Imagine you invested $10,000 in 1989 and setting a goal to earn an 8% average annual return on your investment portfolio. Here, the goal you've set, and if you've earned a consistent return over the entire period, the growth of your account would look like this, and you'd have an ending account value of over $100,000. But the reality of the market is that things don't move in a smooth fashion. After a few years, when the market hits a new high point, it's easy to anchor to that new higher expectation. But if the market drops, you may feel like you've lost, losing sight that you're actually still on track to reach your long-term goal. It's important to keep focused on the long-term strategy and not let the anchoring that may come with short-term volatility steer you astray. And again, it comes back to that staying invested, staying true to the long-term plan. Now, this next bias we're going to talk about is called home country bias. It can be described as our natural tendency to favor companies and products from our home country or region. So let's face it, where we live has a big influence on our everyday lives. For example, where we live might determine whether we call this a can of soda, pop, or Coke. It can explain why we wait decades for season tickets to cheer on a nearby professional sports team, or the style of pizza that we believe is hands down indisputable the best. Now, I grew up at the Jersey Shore, and we had a little restaurant down there called Vic's, and I would argue that Vic's has the best pizza, hands down. So, where we live also influences where we invest. Now, the United States makes up 56% of the total world market capitalization. However, the average US investor allocates over 3/4 of their portfolio to the US markets. The problem with investing so heavily just in the US markets, even with their recent stronger performance, is that the US ranked 24th out of 46 markets in the All Country World Index over the last 20 years. While average US investors prefer domestic investment opportunity, they may be missing out on opportunities offered by foreign investments. Now, the point here is you need to have a well-diversified portfolio. And I know I've thrown a lot of these different terms around. I'm going to encourage you in a moment to reach out, and we can talk about all of these at further depths. But so I'm just going to bring it all home here. In summary, today we looked at several biases that affect us as humans, but perhaps more importantly as investors. And now you may be asking yourself, what can I do to make better financial decisions? Well, let's look at a simple analogy to summarize a pretty good course of action. For health-related goals, studies have shown that people who regularly work with professional trainers are more likely to have success. Why? Because a professional trainer can help you build long-term strategies to achieve your goals. They can keep you motivated and ensure that you stay on track with regular training sessions. Now, I am not a personal trainer. However, similarly, working with a financial professional can help you build a long-term investment strategy. We can help you keep your emotions and biases in check and stay on track with regular portfolio reviews and adjustments. So that's pretty much all that I have for you. I hope our discussion today has helped make sense of some of the common barriers to investment success and the behavioral biases that may affect some of your decisions. I encourage you to please give me a call. I would love to, A, just catch up with you, but B, we could talk personally a little deeper in depth about whatever challenge that you may be dealing with. I'd also love to offer you a personal investment plan to help you meet your long-term goals. And again, we can help to keep you on track for all of your future investments and decision-making. So again, please give me a call. My phone number is on the screen there. That's my email address. Actually, that is not my email address. It's tgrant@TomGrantFinancial. We're gonna have to fire the person who typed that. So it's tgrant@tomgrantfinancial.com. That's my website, is www.tomgrantfinancial.com. Please come visit there. There is a bunch of resources on there, a bunch of videos that yours truly has recorded on a bunch of different topics. So please reach out to me. For those who I did not get back to in the chat box, I will get back to you, I promise, and I will answer any of the questions or concerns that you might have had there. So again, thank you so much for joining me, and look forward to seeing you in future productions of these talks. Thank you.
I should have learned playing drums. Look at that, mama. Could have taken in the camera there. Look at that. So, hands up there. What's that? Hawaiian noises. Banging on the bongos like a chick. Oh, that ain't my that's the way you do it. Get your money for nothing. Get your chicks free. We got to get it on.